Welcome to our review of the September quarter. The quarter contained a number of very important developments that have changed the shape in a favourable way of the probability distribution of the range of possible medium-term economic outcomes. So I'll briefly touch on these and then I'll reiterate the case for our strategy of owning privileged business models with expanding advantages that, in the context of the economic environment we see, are immensely valuable. Let's start with COVID-19. While growth in new cases continues to be very significant in certain parts of the world, the proportion of these new cases leading to hospitalisations and deaths has thankfully fallen quite significantly. We believe people, particularly those who are at greater risk, have generally modified their behaviours to help prevent the contraction and spread of the virus. Frontline healthcare workers have improved their methods of care, and governments continue to improve their systems around testing and contact tracing. We are, of course, closer to a vaccine, although we still have some questions around the timing, adherence, and efficacy of any potential vaccine. Notwithstanding these improvements, the hit to the real economy has been enormous. Fortunately, the response from policymakers has also been large. An important moment took place on August 27th in Jackson Hole, Wyoming, when Federal Reserve Chair Jerome Powell essentially evolved the Fed's inflation targeting objective to one of average inflation targeting. The insertion of this single word is extremely important in our view and essentially guides to an environment of very low and likely near zero interest rates for many years to come. The world's economic response to COVID-19 has also included significant supporting fiscal policies, complementary to supporting monetary policies. In simple terms, while the latter increases lending, the former increases spending and is therefore arguably more potent as a form of stimulus. In the US, for example, the Congressional Budget Office projects a federal budget deficit of $3.3 trillion in 2020. This is more than triple the deficit recorded in 2019. So this is equivalent to 16% of GDP, and this annual deficit in 2020 would be the largest since 1945. And there may well be more to come, which would, of course, be positive for equity markets. And indeed, one of the most significant developments in this regard was the announcement of the €750 billion next generation EU recovery package. Now, this is the first time that the EU will employ large-scale common borrowing to fund counter-cyclical fiscal stimulus to complement the existing fiscal policies from individual national governments. So in summary, we find ourselves in a world in which fiscal deficits are enormous and global central banks have committed to keeping interest rates very low for a long time. And this is a positive development for the prospects of high-quality equities. Against this global economic backdrop, we continue to favour owning the businesses we see as having a very high chance of winning over the long term. These businesses are strongly advantaged over the competition, usually with superior business models and positive data-enabled network effects. Businesses of this calibre generate very high-quality cash flow streams for their shareholders over time. And what makes these cash flows superior is their durability, predictability, and sustainable growth over long periods of time. And in the context of the economic environment we just described, we view these cash flows as being much more valuable than the level at which they are currently being priced by equity markets today. In our quarterly letter, you'll see we included a case study on our investment thesis on Salesforce, which demonstrates our strategy in action. Now, for some of you, Salesforce is unlikely to be a household name like Apple or Google, which are obviously deeply entwined into our daily lives. But within enterprise businesses, there are very few software applications that are more mission critical than Salesforce. And Salesforce is the global leader in customer relationship management, or CRM. Now, what is CRM? CRM is the system used by organisations to keep track of all of their interactions that they have with current, past, and future potential customers. So whether it's keeping track of where you are in the sales process, or how much you have interacted with the company, or delivering a service to your customer, all of this is tracked in your CRM, with the aim of course, delivering a better customer experience and increasing new sales and increasing customer retention. Within customer relationship management, Salesforce is the clear number one, and frankly, Daylight is number two. Salesforce's market share has been structurally increasing for years, and we see it continuing along that fashion. Salesforce has a privileged ecosystem business model, so not only does Salesforce benefit from selling its own applications to customers, but there are more than 3,000 third-party applications developed on top of the Salesforce platform, and Salesforce effectively shares in the economics of these businesses as well. Salesforce sells its application under the traditional software as a service model, which is highly scalable. It results in durable, predictable earning streams for Salesforce shareholders. Salesforce also has significant data advantages. So with more than 150,000 customers, Salesforce has by far the most customer data with respect to how CRM is used. And of course, using this data, they can continue to develop AI-based and predictive tools for further enhancements and to further enhance the effectiveness of the platform for customers. So this is a positive network effect in the business model, and one that continues to grow. And finally, believe it or not, we believe there remains an enormous cross-selling opportunity in Salesforce today, and this will drive significant double-digit percentage growth for many years to come. And of course, we believe this will be reflected in a much higher stock price over the longer term as well. Finally, a quick update on our portfolio positioning, and there really isn't much change from last quarter. As you know, our focus is on medium to long-term compounding, and we believe owning our portfolio of businesses that we see winning over the long term is the best way to achieve this objective. We continue to have meaningful exposures to digital transformation themes of both the enterprise and the consumer, and we continue to own a number of businesses that have leading data advantages, which are also expanding in their own verticals. So we continue to evaluate many new opportunities or potential opportunities, and interestingly, we have been rejecting most of them. The bar for extraordinary business quality today is so high that most businesses are rapidly ruled out by our process. So we'll leave it there. For detailed information on our returns from all of our various funds, please consult our quarterly letters. And if you would like to learn more about the individual businesses we own, or what we are seeing in the world with respect to the US election or other important issues, please take a look at the Insight section of our website at montaka.com. So we thank you again for your ongoing support, and really encourage you to allow the time necessary for the dynamics that we are identifying to be appropriately reflected in equity prices. We really do believe that we are at a unique time in history, and the rewards to the patient investor will be large.